Just to get started, I'll give you a little bit of background, then I'll introduce everybody. They'll introduce themselves a little bit more, just so we can get to know one another. So I currently lead up the commercial team for BFSI at Cognizant for data analytics AI, right? So thousands of people worldwide. We do hundreds of millions of dollars of business every year in this space. I got my start in AI before it was called AI. It was called statistics. And my big breakthrough was I actually got a fellowship at NASA about 20 some odd years back. So I worked on really large data sets before they were called big data as well. We could get our hands onto like almost any data set. This was like kind of post 9/11. And then I also went on to work for like DOD. I've done some of the largest investigations in the world using AI. I've also done one of the largest acquisitions in the world, combining like their data sets, their analytics, and also artificial intelligence. That was when two of the largest beer companies got together and got married. So I got to drink beer with clients on site at their company, which was also a really cool experience of mine. So today we've got Nat from Kettle. He's a co-founder and COO of Kettle. We've got Antoine from SCOR. He's the head of data science. And we've got Glenn. He's the chief analytics officer at New York Life. So we've got a lot of exciting, really knowledgeable people in insurance, reinsurance, specialty insurance, you name it. So I do expect everybody to ask some questions. We're going to go from Nat to Antoine to Glenn, just so they can give you a little bit more background, and then we'll jump into the Q&A.
Sure. Hey, everybody. I'll just tell you first a little about me and how I got into insurance and how we founded Kettle, to give you some context. So actually, my previous work, I worked on opening up data. I was the first chief data officer at USAID and worked in the Office of Science Technology Policy in 2012, 2013. And we were opening up data around humanitarian response in FEMA. I was kind of worked closely during the Sandy hurricane here. And who was really interested in that data were insurance and reinsurance companies, right? That were opening all this government data. I was chief data officer. Really, all I did was run around giving presentations about why PDFs are terrible for a year and a half, and we got somewhere. We created data.gov, and that was fun. But I couldn't really shake how cool this insurance and reinsurance industry was. Truly, I think it's my artist mother apparently said, as I grew up, he can do anything he wants in his life as long as he doesn't become an insurance salesman. So this all happened because I had to really stick it to mom. Sorry, mom. But it just seemed like this beautiful, elegant solution. I had this moment where I realized that. So after being in government, I ran this organization called Ushahidi. It's the largest open source software platform for crisis response in the world. And was watching, the 3x increase in billion-dollar catastrophes that's happened over the last 10 years due to climate change, and saying, wow, if you think about human suffering over time, and was working in first response, there's this huge spike in the first week, 2 weeks after a crisis. And you're trying to save lives, you're doing triage, and that's the kind of software I was building in first. But then the news cycle moves on, the volunteers stop showing up, and you have this long tail where it's just people, their communities, and their insurance companies. And the thought was that the human suffering under that long tail might be just as big as the human tail, the amount under that first 2-week spike. And if you could improve this industry a lot, then you could actually really create a huge impact and help a lot of people, particularly as we see more and more of these terrible events happening from climate change. And that feeling, along with the fact that insurance is this kind of wild thing where we all pool our money together and say, hey, I got your back. If you're the one whose house burns down, I'll throw you 10 cents. And if 1,000 other people do that, you can make $100. And so I hope I did that math right. And that's really wonderful.
This is a math conference.
Yeah. I do the term sheet math. So that's what kicked it off, and I couldn't stop talking about insurance to a point where my wife was like, "Please quit your job and go do something about this, so you can stop talking to me about it." So I did. Met my co-founders Andrew and San, who ran the digital and teams and the technology teams at Argo Group, which is a reinsurer. Especially reinsurer out of Bermuda, and we similarly, we actually got introduced through this guy who was a designer, and I'll stop here in a second, I've been talking a lot, but he's got blonde hair down to here, and I talked his ear off about insurance for an hour, and he's like, man, do I look like someone wants to talk about insurance for an hour? But let me introduce you to Andrew, who's the only other person I know that can make it sound interesting. So we've had a blast. We realized what was happening in the reinsurance industry was, and it's right there in the numbers, there's this 3x increase in billion-dollar catastrophes from climate change has spelled about a 60% drop in return on equity for the industry. And so if the old models were predicting the effects of climate change, then we wouldn't see that drop in returns, right? If we were doing a better job predicting, but we're not. So we need to really come in and bring a much more powerful, much more interesting tool set to be able to do so, because the industry is really stuck in an old stochastic modeling, and as the industry that invented data science back 600 years ago, it really needs an update. We can drive cars and land spaceships back on Earth with machine learning. We should be thinking about how to do a better job underwriting our risk as well using it. So that's the impetus of Kettle. I can get more into it, but that's kind of me and our starting story.
All right.
Yeah. Go for it.
We'll try to keep it short so we can have time for questions. So on my side, I've been working in the insurance industry for 8 years now. So I really started with a PhD, by studying mathematics around applying really machine learning on data and data science on insurance industry. So when we say that, it's really large and broad topics. So I'm really trying to understand from the modeling side up to more like the new techniques coming from data science, how we could leverage that in insurance. So I've done that for 5 years, roughly, working for an international company called Milliman. Then I moved to SCOR, so a reinsurance company. We are a top-tier reinsurance company worldwide, doing both life and non-life business in more than 50 countries. And now, so my team is really responsible just to develop data analytics solutions products. So which means not only focusing on models, but also looking at new type of data we could collect to increase either underwriting process, knowing more about new risk. So you mentioned climate changes is one of them, but in life it would be more about like all the things that could impact the mortality, longevity, and all of those type of risk, which also brings a lot of challenge around modeling, around ethics, monitoring, transparency as well, and bringing also a lot of technological challenges, because it's all about like then how can we embed that into products so we can at least ship those things to our clients, which are insurance companies.
Okay. Hello, everyone. I hope you're having a good conference. My name is Glenn Hofmann. I run the data science shop at New York Life, and I concur with Jersey Nate here that the branding has gotten much better about our discipline. So when I went to school, it was called statistics as well, and it was something that people couldn't even pronounce after a drink at the party. Now it's called artificial intelligence, and that makes for a much better party reception. So I appreciate the branding. At New York Life, I run the sort of a center of excellence for data science and AI. We support many different functions at the company. So New York Life is one of the largest life insurance companies in the United States. So we do fun things like predict how long everybody is going to live, so that's called life insurance underwriting, which has been rather interesting, an interesting job over the last 2 years or so, especially. So you might have heard in the news that life expectancy has changed a little bit, both on an aggregated level and certainly for a lot of individuals. So that was a very interesting time for us. But apart from Apart from life underwriting, we also work on marketing, so consumer marketing problems. Your regular CRM. We do a lot of distribution analytics. So we have a lot of insurance salespeople at New York Life, and we like to predict who might be a good insurance salesperson before we hire them, or predict the performance, the retention, and so on. We also do a lot of finance work, and work for service and several other areas in the company. So there was a lot of, from the sort of catastrophe angle that both of you mentioned, I guess, we've done a lot of COVID mortality prediction over the last 2 years, which was, definitely exciting from a pure science perspective, but a little bit tricky otherwise. We have a lot of medical data of individuals, so there's a lot of interesting, sensitive data there as well that we worked with. All right.
So I think we went from catastrophe to party. Yeah. And I just remember something like a little aside before we jump into the Q&A. I always remember, we always pondered, when is artificial intelligence going to go like mainstream? And when is it going to, when are people going to understand what is artificial intelligence and machine learning? Well, I think we can all attest, it surrounds us in our daily life, whether we know it or not now, and it's become pretty much the party crew, if you will. I think it's probably the coolest area of tech, if you will, right? So, we've definitely covered a lot here. I'm going to jump into some questions. If you have any questions, there is a mic that's going to get run all over the room. I promise you, she will run as fast as she can to you. So just if you have a question, just raise your hand. You can jump in whenever you want. I'm used to getting interrupted. I'm from New Jersey, right? I'm also used to interrupting. we already have 15 questions going once, going right here up front, and then we'll go to the gentleman with the Rev badge on and the white checkered shirt. Go.
Yeah, thank you for the moderator and the three speakers. Yeah, I have a question related to the situation of when the conflicts happen between the AI machine learning models and the human cognition or experience. This is along the line of the keynote speakers this morning. For example, in the situation when the AI or machine learning models predicts, a home or a person is insurable, but from the underwriters' experience or knowledge, I think they would think this person or this house is very high risk. In that kind of situation, so what's the best practice our speakers will know, and what would you suggest if that kind of situation happen?
I can start, I guess. Yeah, I mean, so I guess I'll distinguish between the modeling phase and the real-time execution phase, right? So in the real-time execution phase, that doesn't really happen because there's rules in place that say this is a case that gets automatically decided by the model. And one of the benefits of that is that a human being actually doesn't look at it, right? And then there's cases that are singled out to be looked at by a human being because it might be too complicated, or there's multiple things going on. So in a real-time situation, it'd be fairly rare that the case goes both ways and there's a conflict. In the modeling situation, however, we have to look at that all the time, right? So if you're building an automated model that you want to deploy that is supposed to automate, something that maybe humans do today, or at least in that segment humans do today, then that very much gets reviewed, right? And then it's like, okay, the model decided that, what would the human expert have to say that if there's a conflict, then we walk through it and we say, okay, well, why does this, in our case, the medical expert say this and the model say that? And it's not necessarily true that the human expert is always right, because the model can look at a much bigger amount of data. It can, use a much greater number of variables, and the model or the model building process rather might see some patterns that the human was not aware of. So that could go either way, but we do sort it out before we deploy the model. That's usually what we do.
I can complete. So we do the same as well. So we do provide a lot of underwriting solutions, and more of the time we use like those fancy models, so either XGBoost or deep learning stuff. So sorry for the technical words, but if you try to use more and more complex models, and this kind of automatic decision making is always coming with a human decision, let's say a check at the moment. So we're not there yet to go through this like fully automated underwriting, so letting just one algorithm just like taking the decision. But that's why usually I don't say artificial intelligence, I'll just say artificial efficiency. It's more, it will be more accurate to say that. But yeah, I think we're not there yet just to let just one algorithm, and regulators, they are pretty vigilant about that, yeah.
Yeah, I mean, my addition is that's why you still have drivers in the car in the seat in a Tesla, right? You want it to drive, but you need to have someone who's still a human in the loop. And the best thing the human can do as the experts is really the bug testing, right? And the model should be learning what that expert is checking for, and also being very open-minded that maybe the expert's wrong, and go back and check the math, and if it's wrong, then you need to show it, and maybe that's kind of an exciting moment actually, when you do see that.
It is.
Yeah. You're like, aha. Was there another question, or we want to jump in? Yeah. Oh.
So I guess particularly in the life industry, where policies, the historical record can date back a long time and back before digital processes, and then there's regulatory and compliance issues in terms of how long records have to be kept and what form they take. All of that's highly heterogeneous. And then if you're operating in spaces like forecasting, there might be all sorts of latent variables and heterogeneity in data sources, right? So with respect to the data, the complexity of the data, the heterogeneity, accessing it, how do you work across different areas of the business effectively? How do you make those relationships and forge that in such a way that going forward you really have all of the data that you need, and you're not in a situation where you're developing models knowing that there's cogent data that theoretically you could get access to but don't have?
Yeah, no, that's definitely especially in life insurance, you're right, it's a challenge. So, I mean, New York Life is 176 years old. We don't have data that goes quite that far back. But I joined the company about 6 years ago, and one of the first efforts I did was actually digitizing data. So, we all talk about data as in, it comes through some digital means, right? So one of the first business trips I had was to this big warehouse in New Jersey, where there was literally a huge warehouse full of old policy files, including underwriting records that dated back until like 25 years ago, right? From like 10 years ago to 25 years ago. And we literally set up a process to digitize all the underwriting records that we wanted to use for modeling. So we basically created our own data by having somebody pull out the files, take out the right piece, take off the staples, line it up with the scanner, send it through, and then do the OCR on that to create our data for models. Now, and then after that process, what you also said was you have different standards at different points in time, and you might even have different standards in different states of the country, right? So we probably had, I think we had 200 versions of like the application form for life insurance in the last 25 years, right? And we really had to make a very, very diligent effort to line up the field. The question was asked a little differently, how you have to adjust the output to make it consistent. So, I mean, it's never going to be perfect, but you try to line up the data so it's as consistent as you can make it for your model. So, I mean, you're absolutely right. It's a challenge. It's labor intensive. But when you want to predict life expectancy, you have to go back, 15, 20 years, because that's, I mean, people live a long time.
I think there's a question up here with the lady in yellow. If you can come up and run as fast as you can. She's been waiting for a while now. No, I'm joking. If there's other questions, just raise your hand so I can kind of map it out.
I'm so small, it's hard to notice me.
Okay,
Yeah.
now you can ask your question. We have
Yeah, and my
32 more
question is
questions to
particularly
go.
for New York Life. So how far have you automated underwriting? Are you using AI ML for your underwriting? Because I come from an insurance industry. I left insurance industry 5 years back. I spent 12 years there. But then, even then, business rules-based underwriting system were in place. And this thought process that underwriters are going to lose jobs because of automation of underwriting. So coming to AI space, have you adopted artificial intelligence in underwriting?
Well, let me put it this way. So I've been in the life insurance space for about 6 years now. Before that, I was in credit, consumer credit, and then I was in auto insurance and home insurance. And so when you look at consumer credit, when you look at auto insurance, even home insurance, underwriting is almost entirely automated there now, at least on the consumer side, less on the commercial side, but on the consumer side. Life insurance is, a little bit behind that process, but so we're just really at the beginning of the journey of automation. So we have automated certain pieces of the underwriting process, but it's still very far away from complete automation. And the reason for that is there's a couple of reasons for that. When you underwrite an auto insurance policy, the term of an auto insurance policy is typically 6 months. The term of a home insurance policy is typically 12 months. The term of a life insurance policy could be 50 years, right? If you buy a whole life policy, you can keep that until you die. And we underwrite some people that are 20 years old. They might live well into their 80s, and they could keep the policy that long, right? So we have one chance to underwrite a policy that may be in force a very long time. So you can't correct that mistake 6 months later or 12 months later. So it's a lot, there's a lot more pressure on that decision. The second reason is that the data is a lot more complex, right? So if you've gone through a life insurance underwriting process, right, you fill out an application form that's quite detailed. We collect your prescription history. We send you, or we send a paramedic to you, or send you to a paramedic to get blood and urine tests. We might request your doctor's notes, right? So there's a lot of very detailed data that is specifically medical, and some of that is fairly standard, and a lot of it is not. And so human intelligence is still quite valuable in that process. So we are tackling that, and we're automating more and more, but there's still a long way to go.
And it's the same in every country. So every country wants to go to the direction of fully automating underwriting, even in life. Mm-hmm. So as Glenn said, it's not so easy to do that.
Hey, thanks for being here, everyone. And you really spoke to this a little bit, and then thinking about the long history in the past. We've heard a lot in this conference about model ops and model monitoring. When you have such a long time horizon before you sort of know if models are performant or not, can you talk about sort of the challenge there and how you monitor the models that you've built?
We do monitor on a yearly basis, or at least twice or every 6 months at maximum. But it comes with, especially in the life risk, it just, since it's long term, usually you have to wait a certain time before you actually see if your pricing assumption or what you expected actually happened. So the only thing you can really monitor on, let's say, more regular basis is actually the distribution of the population you underwrite every day, and try to guess if it's drifting to an area in which you would like just to not so, like if you target super preferred profiles, a good risk, and you realize that actually those one might be not as good as we expect. Perhaps you have an issue with your model in terms of risk selection, or might be coming from disclosure issue, come from the networking agents, brings a lot of complexity, but In practice, at least at SCOR, since we're more on the B2B relationship, we usually monitor it on more like, I would say, it's not an automatic process, but it's something we implement more on the, let's say, on the model delivery more than on the monitoring, I would say.
Yeah, I mean, I would say there's probably 3 different aspects to model monitoring, right? So one is what Antoine said nicely, which is sort of data monitoring. So if you have a real-time model, monitor the data, the distribution of the data that goes into the model, right? So let's say you have labs that collect, blood data, right? If they change the metric and the distribution changes, we would want to know that right away because it screw up the whole model, right? So you have, ingoing data monitoring, score distribution monitoring. That happens in real time. It's automated. Then you have operational reporting monitoring. So to our underwriting group, or in this case, or our marketing group, or distribution group, whatever the model is, we have to send a bunch of business reports so they see, what sort of population is going through the model, how are they scoring, what's the outcome, so they can create some financial reports on that. That's the second one. And the third one, which I think you're mostly referring to, is model validation, essentially, right? So model validation, when you have a marketing model where you do digital marketing, you could do that daily, right? Because you get feedback. Oh, did they click on this? Did they not click on this? Did they call in? Did they not call in? You could do that daily. Well, on life insurance underwriting, I mean, you can't really do that at all because you have to wait till they die, and that might be several decades from now, right? We hope that it is many decades from now, as a matter of fact, right? So all you can do is backtest, right? You can't really, on the data we're underwriting now, we can't validate until several decades from now.
Yeah, in our case, looking at cat models, we focus on fire predominantly right now. I mean, it is an annual cycle, right? And so you do get to kind of see annually how'd you do. But cold start problem, how do you know what to put into production? And what we do is we test a bunch of models off of each other. That is it's back testing, and trying to validate to the best of your ability. And then one of the advantages with machine learning versus kind of the normal in that space is we can run 500 billion simulations each turn of the model versus kind of the normal 10 to 100,000 that's done in the industry. So that just gives you that higher definition, really. Although the thing that I get excited for, if that technology could actually improve the business outcomes in this space, is it is a extremely illiquid asset, right? There's a year contract, but then you're on, people putting the money behind it or sitting behind it, and but it does actually change. Like our models, we could be running throughout the year and being like, hey, you know what? It's riskier now in October because it didn't rain for the last 6 to 8 months than it was in January, there's a bit of this with ILWs and cat bonds, if you guys know this world, but like it's very little that is done in fire, and even with cat bonds, it's like really just, hey, calling up, hey, can I sell you this? What do you want to charge? It's a phone call, and you could use, I think, really ground that much more in the modeling real time, releasing sort of a weekly update to the risks to be able to create something that's much more liquid and tradable that I think the technology can enable for the industry, because everyone's used to being able to trade stocks day to day, right? Same thing. Risk, it's just trading risk.
Hello. For me, I really interesting from your company and what kind of new thing you have tried recent year in terms of like additional data source or modeling methodology. Or even you have tons of data you never used before, but since you have some new things you want to try, and then you can use have a definitely good value for your data. And in terms of methodology, for example, for life insurance, we all know we use a certain traditional machine learning methodology to predict how long people will live. But do you feel this latest deep learning model can improve your model performance or anything new you try, I would love to learn.
I can jump
Thank
in.
you.
That's one of the things we are the most proud of is actually like applying what we call dynamic survival modeling. So it's really like we study actually the usage of deep learning on structured data, which is not so common when you look at it in the insurance industry. And what we try to it showed some success so far. So we are in implementation phase right now. So instead of having just one picture of the data we collect when we do try to assess the risk, so you ask your questions, the person just discloses different information, then you say, okay, I accept the risk or not. Instead of just doing that in one point of time, what we studied was like using recurrent models, so deep learning models, just to see what if we look at just not one only data point, but the full historical data, and try to assess the risk not based on just like one picture in point of time, but all the entire dynamics that came before. So the good example is like when you're someone, usually in life insurance, BMI is a key driver in terms of risk. You usually have those kind of thresholds. So we say, okay, people below 25 are pretty good risk, but above, we probably ask them to have a certain loading factors just to compensate that risk. But if you look at it, it's just like when you do that, when you ask the applicant to say, what is your BMI at this point of time, it's not the same. And when you discuss that with the medical practitioners, they agree with that. Just say, it's not the same someone being 25, but who used to be 20 last year. So you know that it's going in an increasing trend, which is pretty bad, versus someone who might be a little bit above the limit, so 26 or 27, but you know that is going down. So capturing this dynamic, so we did the study. So if you're interested, you can just look for survival papers from SCOR. We did like a long study, so but just like say, okay, how can we apply actually machine learning models to these specific use cases, like studying the life modeling, because you need to adapt the models. You cannot just like import your scikit-learn stuff. It will not work. So we did that, and we also did adapt the deep learning model so it can also work for this new type of data. So, and this was a theory, and the good thing is that actually in many countries now, we realized that actually we could access to such data sets. So not only having one data point, but being capable just to look at the full historical data in the past. So it's pretty exciting, and I think it might change potentially in 3, 5, 4, 5 years the way we do underwrite people. Yeah.
I think that would be pretty cool. Yeah. So I think we'll be looking out for that.
With pleasure.
I'll answer you. I think you had two parts of the question. One is data, one is algorithms, right? So from a data perspective, so for us, right, we have to make sure the data that we use is available on a large population, right? So that's always sort of a bit of a constraint. People talk about new data all the time, but it's only the people that have this particular device, and that's only like 1% of the population. That doesn't really work for us that well, right? So, but there are some new, not new data sources, but new data sources available in volume. So I mean, electronic health records is probably the first example. That is now, at least in sort of a small layout, relatively standard, and we can get it in a large population. Medical claims data is another one that is, very strongly increasing now, so that we're starting to use. Not universally available, but enough of a portion of the population that makes sense for us to use it. Hopefully in the future, the Apple Watch and Fitbit, and so the tracker data essentially, will be more available. That's still a little bit tricky today, but I hope that will be in the future, because what we don't have today is really activity data, right, on humans, and activity data is probably very predictive of people's morbidity and mortality. So that's not yet being used, but I think that's a thing that we're looking out for in the future. So that's from a data perspective. From an algorithm perspective, I'll give you a different example. Not from underwriting, but from our sales, our distribution area. So one of the things we had to do, New York Life has 12,000 agents selling life insurance, right? And we like to predict, are they going to retain? Are they going to stay with us? How much are they going to sell? Are they going to make their goal by the end of the year? And there's like 2 other things, right? So there was like 5 things that our sales department would like us to predict, right? But and those different categories of agents and different months of the year, and so we sort of had this dilemma. If you want to satisfy all those requests, we have to build like 150 models or something like that, right? Now that's a pain, right? And it's also inefficient, right? So we actually used neural networks to predict multiple targets in one model. So I thought that was a pretty nice application of neural networks. Not so much for neural networks to be better than a logistic model or straight regression model, but for its ability to predict multiple targets in one model. So that that was a neat application.
For us, it's really geospatial data in the space. So the historical way of doing it is looking at historical, say, fires. So highly weighted towards a historical fire polygon that is the main indicator toward where future fires will be. And the truth is actually that single data set, it is the single best indicator by itself. But its ability to predict future fires has eroded year over year over the last 10 years. And so it kind of was a classic 80-20 rule. It worked well enough for years, so we'll just do it that way. But now, due to climate change, it's right there in the words, the climate changed. So it doesn't work as well as it used to. And so we built a more ground-up physical model and understanding, and then and so we're running, we look at geospatial data, predominantly weather data. There's about 53 different data sources we're grabbing from, and then we look at about 65 different indicators. Historical weather data, historical fire still being the backtesting data set that we can use a lot, and playing off of that, but we're also diving into to anthropomorphize the model, right? What's interesting about fires, there's actually 10,000 to 11,000 fires a year in California. About 10 of them cause 99% of the damage every year. And so that's an interesting data set to start work off of. So one model is looking at chance of fire starting, and it goes, oh, I recognize that 92% of the time fires start, it's when you have these brown dots right next to these long straight gray dots, right? Oh, that's because 92% of fires start alongside roads. It doesn't know it's a road, it just knows that that's the pixelation of the geospatial imagery that is going to cause. But I also know, like, oh, well, there's this other big gray spot to the east of it. It doesn't go anywhere. It's one of the fires that never becomes one of the 10 crazy fires, because all we care about are the 10 crazy fires, right? We only attach at 100 million limit. So we're actually very good as humans at putting out fires. What we're not good at is when fires get really crazy, putting them out. So which are the ones that are going to get out of hand? And so if it's a fire starts, but it runs into a Walmart parking lot, doesn't go anywhere, not a big deal, right? And so what gets more interesting then is looking at the spread model and saying, okay, now we're here, the fire starts off this geospatial, but then there's 20 miles of brown area to the east of that, and there's no other road access to it, and it goes uphill. And we know that fires burn 10 times faster uphill than downhill. Topography doesn't change, so that's a nice, easy data set. We also know that, like, wind, this is off the 101. It blows around 90 miles an hour right now because the Santa Ana winds usually in October. And as I mentioned, there's no other road access, which geospatial access as well, so there's no way for fire trucks to get in here and put it out. Now suddenly you've got multiple of these indicators all going in the wrong direction, and you start to have a real hot spot. Now, if you're down in Big Sur, like the one that happened in January, and it burns and it doesn't burn any homes, no one cares, right? Oh, it's going to hit 2 more highways before it actually gets to a development. Not a big deal. But if you're up in Santa Rosa, that's the campfire. Suddenly now you're taking out 20 billion worth of risk in a single fire because this hot spot is really dangerous. And so part of what we really want to do too is identify those and start telling CAL FIRE and things, go do forest thinning right here. This is bad. That's mitigation efforts. And that's what I love about insurance is you can kind of like, you're like, oh, this is why you should, why health insurance wants to pay for your gym membership, right? When it's like, this is mitigation, it helps. So
I think we've got time for one final question. So if you'd like to ask, and then we'll wrap it up.
Yeah.
I'll take it, yeah, since I have the mic. Thank you all for your time. And my question is regarding priorities within your organizations when it comes to the data science teams. What are some of the use cases you're seeing come up more? Has there been a change over the last couple of years? And where is it going, you believe, in terms of your use cases? In catastrophe reinsurance as well as life, I'm also trying to assess, are we seeing any commonalities across? So that was what I was trying to just understand in terms of use cases.
Main trend is definitely all the stuff around underwriting is a key hot topic. on the life side at least, the fully automated underwriting stuff. And non-life, I will keep it short so we can also answer. On the non-life side, we have a lot of use cases around the usage of new mobility data like IoTs, telematics, usage of satellite data. So it's more about like how can we understand better the risk based on information that we're not able just to process 10 years ago. While on the life side, it's more about like, let's do it in a better way, more modern ways also, and let's take it as an opportunity also to modernize the risk selection model just to be a little bit more fair in terms of in the way we price and the way the medical, let's say, research also did progress during the past 10, 12 years.
I think I'll just add one. I mean, we are a startup whose entire structure and mission is ML for underwriting. So everything is in that bucket, and that's all we're really doing. But one that's different from understanding the risk itself that was really kind of innovative for us and blew my mind that doesn't happen at the reinsurance level is we built kind of a dynamic pricing modeling taken from hedge fund balancing off of like a Markowitz portfolio theory structure. And so when we sell like one of our parametric covers covering like a certain grid, that first one might be a 10% rate on line. Like we'll charge 10 million for 100 million a cover. Oh, but if you want to take the other square kilometer next to it in Sonoma, oh, that one's going to cost 30. And if you want to take the next one over it, that one's going to cost 50. Because I don't want to cover 3 squares in downtown Sonoma all right next to each other. So using pricing, it begins to really incentivize diversification. So we when we're writing, all of our homes are geographically dispersed, and which is wild because normally what happens in reinsurance, it's like you do all this kind of geographical thinking at the insurance level, and then you throw all that out in reinsurance to just go, okay, now we're just going to attach it 100 million. We're going to cover the whole state, whole peril. And I just think that's crazy because if you have some hotshot agent writing 200 homes in one neighborhood in Paradise, California, you've blown your entire tower out. So we do that, and we would love the entire industry to kind of move along that way because it's a geographic-based risk. So that's one of the key things we focus on.
So my answer is going to be a little bit different. So I run a corporate center of excellence for data science, and so we support the entire company of New York Life with data science. So generally, priorities mimic business priorities of the company. Which meant I mean in March 2020, guess what the first priority was? COVID modeling, right? So so it was like set up like a large part of the team to understand COVID data, what comes out of the CDC, what comes out of the New York Times, what are other sources? Should we talk about hospitalization? Should we talk about cases? Should we talk about deaths? What are the idiosyncrasies of that data? How do you build some hierarchical-based models that mimic the pandemic models that universities have? So that became a priority. Then, shortly after that, we had a lot of disability, right? So a lot of people were taking short-term disability, going into longer-term disability because of mental reasons, other things that happened during the stress of the pandemic. So all of a sudden, we were looking at disability claims and what's going on there, right? Now that for life insurance, last year was a huge sales year. So the demand for life insurance during the pandemic apparently goes up a lot, which was good for sales, not so good for claims, right? So it depends. But this year we're coming off like a huge sales year of last year. So this year it's all about sales. How can we grow sales again? Coming off a record year. How do we make our agents more productive? It's all about sales. So it really mimics the business priorities of the company at the time.
So thank you, Glenn, Antoine, Nat. Really good discussion. Thank you all for all of your engagement here. A lot of really good questions and a lot of questions. If you have any further questions that you want to ask, you can come up here. The 4 of us can kind of field those questions more on an individual basis for some time. And I just wanted to thank everybody, and I hope your travels back home are uneventful. super easy, and you enjoy the weekend. Thank you.
Right.